Intelligent Investor. This video breaks down Benjamin Graham's timeless investing framework from The Intelligent Investor, the book Warren Buffett calls, by far the best book on investing, focusing on value, discipline, and protection from mistakes. Core ideas: value versus price, margin of safety, investor psychology, Mr. Market, defensive versus enterprising strategies, and practical portfolio policies to build wealth over decades. Part 1. Investing versus speculating. Graham draws a clear line. An investment operation promises safety of principal and adequate return. Anything else is speculation. Intelligent investing requires analyzing a business's intrinsic value and ignoring market fads and short-term noise. Focus on long-term ownership of businesses with sound fundamentals instead of trading on headlines or momentum. Part 2. Price versus value, the foundation of value investing. A stock is an ownership share in a real business. Its true worth, intrinsic value, is separate from the price the market quotes daily. The market swings between optimism and pessimism. Intelligent investors buy when pessimism makes prices too low and sell to optimists when prices are too high. Higher purchase prices imply lower future returns. Return is a function of the price paid relative to value. Practically, investors estimate intrinsic value using fundamentals, assets, earnings power, competitive position, and quality of management, and compare that value to the market price. Part 3. The margin of safety, Graham's prime directive. The margin of safety is the buffer between a company's intrinsic value and the price paid. Buying well below value protects against errors, bad luck, and uncertainty. Graham urges never to overpay. Insist on a meaningful discount to intrinsic value, because valuation is imprecise and the future is uncertain. Even great assets can be poor investments if bought too expensively, while mediocre assets can work at a low enough price. Practical application: require a sizable discount. Often practitioners use 20% minus 50% depending on quality and certainty, and diversify enough to let winners outweigh inevitable mistakes. Part 4. Mr. Market, mastering your emotions. Graham's allegory. Mr. Market is a manic partner who quotes a new price every day, sometimes sensible, often silly. The quote is an opportunity, not guidance. The job is to act only when Mr. Market offers a favorable price. Otherwise, do nothing and let price come to you. In the short run, markets are a voting machine, popularity; in the long run, a weighing machine, business reality. Key takeaway: be rational, patient, and contrarian when necessary. Profit from market folly rather than participating in it. Part 5. Defensive versus enterprising investor. Defensive investor prioritizes simplicity, safety, and minimal effort, typically uses broad diversification, quality screens, and a balanced stock-bond mix. Enterprising investor, willing to do more work for potentially higher returns, hunts for undervalued securities, special situations, and bargains with strict discipline. Choose the path that fits temperament, time, and skill. Self-knowledge is central to Graham's framework. Part 6. Portfolio policy, practical rules. Asset allocation. Maintain a sensible balance between stocks and bonds, adjusting within a reasonable range based on valuations and personal circumstances to control risk. Diversification. Spread risk across enough holdings to ensure that a few errors don't derail results while avoiding over-diversification that dilutes returns. Quality focus. Prefer financially strong companies with earnings stability, sound dividends, and prudent management over speculative stories. Expect volatility and plan to benefit from it. Use swings to buy at discounts. Rebalancing can enforce buy low, sell high behavior. Part 7. How to estimate intrinsic value. Intrinsic value blends quantitative and qualitative judgment, earnings power, asset value, growth durability, competitive advantages, and capital allocation quality. No single formula is perfect. Use conservative assumptions and multiple methods where possible to triangulate value. Build a checklist: financial strength, low debt, ample interest coverage, stable earnings, reasonable P/E versus history and peers, dividend record, and understandable business model. Part 8. Intelligent behavior, temperament over IQ. The secret to financial success lies in discipline and behavior. Resist crowd emotions, think independently, and be patient. Don't let price action dictate conviction. Anchor decisions in analysis and margin of safety, not fear or greed. Accept that being wrong is inevitable. Protect against it with price discipline, diversification, and a long horizon. Part 9. A simple step-by-step game plan. Define investor type, defensive or enterprising, based on time and temperament. Build a policy, target allocation to stocks, bonds, rebalancing rules, and a watchlist process for candidates. Screen for quality and value. Set thresholds for financial strength, profitability, dividend record, and valuation multiples. Demand margin of safety. Act only when price offers a meaningful discount to conservative intrinsic value estimates. Use Mr. Market to advantage. Buy when pessimism creates bargains. Trim or sell when enthusiasm inflates prices beyond value. Review, don't react. Periodically reassess fundamentals and allocation, not daily prices. Graham's timeless message: investing success comes from buying businesses below intrinsic value, maintaining a margin of safety, and managing one's own emotions more than the market. Whether defensive or enterprising, adhere to principles, analyze value, demand a discount, diversify prudently, and let time and rationality compound results. Key principles of value investing. Focus on intrinsic value. Estimate what a business is truly worth based on fundamentals, assets, earnings power, cash flows, competitive position, and management quality, then compare that to the market price. Margin of safety. Buy only when the price is meaningfully below your conservative estimate of intrinsic value to protect against errors and uncertainty. Price is not value. Treat market quotes as opportunities, not instructions. Short-term price swings don't change a company's underlying worth. Mr. Market mindset. Be patient and rational. Act when the market is overly pessimistic and offers bargains, and avoid chasing enthusiasm. Business-first analysis. Study the business, financial strength, profitability, cash generation, durability of advantages, not just the stock chart. Quality and financial strength. Prefer companies with solid balance sheets, consistent earnings, ample free cash flow, and prudent capital allocation. Discipline and temperament. Stick to your process, avoid herd behavior, and let time do the heavy lifting. Temperament matters more than IQ. Diversification with intention. Hold enough positions to limit damage from mistakes, but not so many that you can't monitor them effectively. Long-term orientation. Base decisions on multi-year business outcomes, not short-term market noise. Clear policy and process. Define your criteria, screens, valuation methods, thresholds, require a margin of safety, and review periodically rather than reacting to price moves. Long-term investment strategies. Define clear goals, time horizon, and risk tolerance, then align your asset mix, stocks, bonds, cash, alternatives, to that plan and stick with it through cycles. Diversify broadly across asset classes, sectors, and geographies to reduce single risk exposure and smooth returns. Use low-cost index funds, ETFs, as core holdings to achieve diversification and keep fees low, which materially improves long-run outcomes. Practice disciplined asset allocation and periodic rebalancing, e.g., annually or by bands, to buy low, sell high systematically. Embrace dollar-cost averaging. Invest a fixed amount on a schedule to reduce timing risk and harness volatility. Start early, reinvest income, dividends, interest, and let compounding work. Time in the market is a primary driver of results. Avoid market timing. Accept that volatility is normal and remain invested to capture recoveries and long-term growth. Match risk to horizon. Higher equity weight for longer horizons. Increase bonds, cash as goals near to reduce drawdown risk. Understand investment risks upfront and pick a strategy you can stick with emotionally, especially during downturns. Use tax-advantaged accounts and tax-efficient practices, asset location, long holding periods, harvesting losses where appropriate to boost net returns. For equity selection overlays, favor quality and value disciplines, strong balance sheets, durable cash flows, reasonable prices, and require a margin of safety. Consider target date funds for a set it and forget it glidepeth if you prefer simplicity with professional allocation management. Practical setup in 6 steps. Set objectives and constraints, return need, drawdown tolerance, liquidity, taxes. Align your stock bond cash mix accordingly. Choose core building blocks, global equity index fund, investment grade bond fund, then add diversifiers if suitable, small caps, international, real estate. Automate contributions via dollar cost averaging and set rebalance rules, calendar or 5 to 10% bands. Reinvest dividends, interest unless you need income now to maximize compounding. Establish, stay the course, rules to avoid timing the market, volatility and drawdowns are expected. Review annually to reassess goals and risk, not to chase recent winners. Key mindsets. Patience over prediction. Focus on time in the market, not perfect entry points. Costs, taxes, and behavior are controllable, and cumulatively decisive over decades. Diversification and consistent contributions help you endure lost decades and uneven cycles. Role of ETFs in long-term growth. ETFs play a central role in long-term growth by providing low-cost, diversified exposure to markets, which improves risk-adjusted returns and harnesses compounding over time. Key ways ETFs support long-term growth. Broad diversification. A single ETF can spread your money across many stocks, sectors, or even asset classes, bonds, commodities, reducing single stock risk while capturing market returns. Low costs. Expense ratios are typically lower than actively managed funds, and keeping fees down materially boosts long-horizon outcomes. Tax efficiency and reinvestment. Many ETFs are structured to be more tax efficient than mutual funds and allow convenient dividend reinvestment, aiding compounding. Liquidity and flexibility. ETFs trade intraday like stocks, enabling easy rebalancing and systematic strategies without waiting for end-of-day fund NAVs. Core building blocks. With just a few broad market ETFs, investors can build a diversified portfolio across equities and bonds aligned to risk tolerance and life stage. Accessibility. Wide range of choices, broad index, factor, smart beta, international, bonds, dividends, minimum volatility lets you tailor a long-term mix for growth and stability. How to use ETFs for long-term growth. Make ETFs your core. Use broad, low-cost equity and bond ETFs as the core, then add targeted exposures, e.g., small cap, international. Quality, as needed. Automate and rebalance. Dollar cost average into ETFs and rebalance on a schedule to stay aligned with your risk and buy low, sell high systematically. Match risk to horizon. Favor broad equity ETFs for multi-decade horizons and increase bond ETF allocation as goals approach to reduce drawdowns. Mine tracking and liquidity. Prefer established ETFs.